So you might have noticed gold was on an absolute tear, hitting a 6-week high, and then, bam, seemingly out of nowhere, the price just dropped. What in the world happened? Let's break down this sudden fall and figure out what it could mean for the future.
I mean, when an asset is on that kind of hot streak and then just reverses course, you gotta ask, right? Was this just a temporary blip, a little bump in the road, or is there a much bigger story unfolding here? Let's dig in.
All right, so first things first, let's establish the cold hard facts of what exactly went down. Here's the number that really got everyone's attention. On December 2nd, 2025, the spot price of gold fell to $4,186.89 an ounce. Now, after the incredible run it had been on, a drop like this, yeah, that definitely got the market talking. And this wasn't just a minor dip in one area. It was across the board. Spot gold dropped 1.1%, and futures fell even more, down 1.3%. The real puzzle for investors was the timing. Why such a sharp drop right after hitting that peak? That's what we need to figure out. So, what's the most immediate, the most straightforward explanation for a drop like this? Well, it often comes down to a classic, very human market behavior. Peter Grant from Zaner Metals has a really clear take on this. He's suggesting, hey, this is likely just profit-taking. Investors cashing in their chips after that nice price surge. And he makes a crucial point. The main event that the market is focused on, the expectation of an interest rate cut, hasn't changed one bit. And just so we're all on the same page, what is profit-taking? It's exactly what it sounds like. An investment goes up in value, so you sell it to lock in those profits. Makes sense, right? After a rapid climb like the one gold just had, it's a completely natural and pretty smart reaction from investors. But here's the thing. Profit-taking is just the immediate trigger. To really understand the bigger picture here, we need to look at the most powerful force in the entire market right now. Right, so profit-taking explains the timing of the drop, but it's not the main story. The real driver, the engine that the entire market is watching, is the U.S. Federal Reserve and whatever it decides to do next with interest rates. So the market's thinking on this follows a pretty clear logical path. First, you've got economic data coming out that shows the economy is cooling off of it. Then, in response to that, you start to hear Fed officials using a more dovish tone, which is just Wall Street speak for less aggressive. You put those two things together, and what's the market's logical conclusion? Interest rate cuts are probably on the way. And listen, this isn't just a wild guess. This is a full-blown market consensus. Traders are pricing in a massive 89% probability that the Fed is going to cut rates at its very next meeting. You just don't see that kind of certainty very often. The market is screaming its expectation here. So why does all this talk about the Fed matter for a shiny metal? Well, this breaks it down perfectly. When interest rates go down, it makes other assets that pay you interest, like bonds, a lot less attractive. All of a sudden, gold, which doesn't pay you any yield, starts to look a whole lot better in comparison. The opportunity cost, what you're giving up to hold gold, just gets a lot smaller. And it isn't just everyday investors. We're talking about central banks getting in on the action. The World Gold Council's data shows that they bought up 53 tons of gold in October. That is a 36% jump from the month before. That is a huge signal of confidence from some of the biggest players in the world. Okay, so you've got a market that's overwhelmingly expecting rate cuts, and you've got the big banks buying in. So what does all this mean for the future price of gold? Remember Peter Grant, the expert from Zaner Metals? He thinks this recent dip isn't a setback, it's a launch pad. His projection is pretty staggering. He sees gold potentially hitting $5,000 an ounce early next year. So what should you be watching for? It all comes down to the data. This week, all eyes are going to be on the ADP employment report. And, even more crucially, the Personal Consumption Expenditures Index, or the PCE. That PCE number is the Fed's absolute favorite inflation gauge, so you can bet it's going to heavily influence their next move. And all of this leaves us with one big, provocative question. The stage is set. The market is ready. Demand is strong. So, was this recent dip just the quiet before the storm? Will the Fed's next move be the very catalyst that pushes gold to a brand new record? I guess we'll see. All eyes are on the data.